You've seen them, right? Those stock charts with all the crazy zigzagging lines. And you've probably wondered, what if I could actually read that? What if that was some kind of secret map to making a ton of money? I mean, it's a really seductive idea, isn't it? That you could predict where the market's headed with just a screen and some smart analysis? But is it actually true? Yeah, that's really the million-dollar question we're digging into here. Can you genuinely look at what a stock did yesterday or last week and use that to consistently, and I mean consistently, beat the market? All right, let's get into it. Okay, so first things first, we have to get our heads around the basic premise here. It's a field called technical analysis, and the core belief is, well, it's that you don't need anything else but the chart. Everything you need to know, the patterns, the trends, even the whole psychology of the market, it's all supposedly right there, written in those squiggly lines. Now, it's super important to know that this is a completely different world from the other main way people invest, which is called fundamental analysis. That's where you're digging into a company's health, right? You're looking at their earnings, their debt, their leadership, all that stuff to figure out what the company is really worth. But we're not going there today. Nope. We're focused purely on the chart readers. So if you boil it all down, the whole game of technical analysis rests on one huge assumption, that history repeats itself. It's kind of like trying to predict tomorrow's weather just by looking at the cloud shapes from yesterday. I mean, maybe it works, maybe it doesn't, but that's the big question, right? Does it actually work? So to figure this out, we need a proper showdown, a head-to-head battle. In one corner, you've got the complex, high-action strategies of the technical traders. They're constantly buying, selling, moving in and out based on signals from the charts. And in the other corner, we have the simplest, maybe even the most boring strategy you can imagine. You just buy some stocks, and then you hold on to them. That's it. And to make sure this is a fair fight, we need an impartial referee. And that's exactly what we have, a seriously rigorous 12-year-long academic study out of Sweden. They put all of these strategies to the test using real-world data. So we're not talking about opinions or what some guy on the internet says. We're talking about cold, hard numbers. So how exactly did they set this whole thing up? Well, the researchers created a really specific experiment to see which of these approaches would actually come out on top over the long haul. Let's break down the rules of the game. Okay, here's the setup. The playing field was Sweden's top 30 stocks, and they looked at a big chunk of time, a full 12 years, from 2000 all the way to 2011. They tested a bunch of really popular technical trading strategies, things you've probably heard of, like simple moving averages. That's just a way to smooth out the price data to spot trends, plus some other common tools traders use to get their buy and sell signals. And of course, the big test was comparing every single one of those strategies against that one simple benchmark, the buy and hold strategy. All right, so after 12 years, after literally thousands of trades and crunching mountains of data, who won? Did all the intense, active, complex strategies of the chart readers pay off? Or did the simple, patient, boring approach end up on top? The moment of truth. And here it is, the results. So what you're seeing here, each little group of bars, that's a different time period they studied. Now that blue bar in each group, that's our simple buy and hold strategy. Just look at period 1 and period 3. The technical strategies, all those other colorful bars, they actually lost money on average. They're below 0. Meanwhile, buy and hold stayed in the green. Now in the other periods, sure, it was a bit of a closer race, but when you step back and look at the whole picture, well, it's pretty undeniable. And hey, if that chart wasn't clear enough for you, here is the absolute knockout punch. This is a direct quote from the people who did the study. They concluded that there was, and I quote, no statistically significant excess return. Okay, so what does that academic speak actually mean? It means all those fancy, complicated strategies, they didn't really give you any extra benefit at all. So the verdict is in. When you strip away all the hype and just look at the data, it's crystal clear. All that complexity, all that chart reading and constant buying and selling, it just failed to consistently beat the super simple plan of just buying and holding on. But that brings us to maybe the most important question of all. Why? Right? Why did the more complicated active approach fall flat? Because understanding this is really the key takeaway for anyone who's thinking about investing their money. So why didn't all that intense analysis and trading lead to better results? Well, the answer really boils down to two big, powerful ideas. Okay, first up, there's a big academic theory called the efficient market hypothesis. But don't worry, The simple version is this. By the time you spot a cool-looking pattern on a stock chart, you're already too late. The market has already reacted. All the information out there is already baked into the price of the stock. So the theory goes, there's just no secret edge you can get from looking at old data. And the second reason, well, it comes down to this tiny, tiny number, 0.095%. This was the average transaction cost, the small fee you pay every time you make a trade that the researchers factored into their math. I mean, it seems like nothing, right? Totally insignificant.
But it's not. Here's the killer. Technical trading involves a ton of trades. You're constantly jumping in and out of the market, and every single time you buy or you sell, you get hit with that tiny fee. It's like death by 1,000 cuts. Over hundreds or even thousands of trades, those tiny little costs add up to create this massive drag that can completely wipe out any profits you might have made.
So in the end, what this massive 12-year experiment really shows us is that complex isn't always better, not by a long shot. Think of it like this. The buy and hold strategy is like planting an oak tree and just letting it do its thing, giving it time to grow strong. But frequent trading, based on all those chart signals, that's like going out every single day and digging up that tree just to check on the roots. All that frantic activity doesn't help it grow. It actually gets in the way. Which kind of leaves us with one final big thought to chew on. We live in a world that's constantly selling us on complexity, on finding the next secret formula. But what if the simplest investment strategy is actually the smartest one? Based on the data, that seems like a question that's definitely worth asking.